Hi, good morning friends. Once again, welcome back to this session for options. So in the previous session, we just went through this particular slide where I showed you call and puts, how it appears on a real time. So I just wanted to re-show you this slide. In previous class, I missed to show you the actual contract. So this is marketwatch.com. You can view the options over there. So you see the options for Apple stock, and I have just there are various expiry dates. You can choose any of these dates. I have just taken June 2021. And on the left side we have in the headings, you can see these are the calls, these are the puts, these are the various strike prices. Currently Apple is trading at 127, so anything above 127 like 130, 135, these are out of money for calls and they are in the money for puts. So you can see the last traded price, they are higher for the puts and they are in the reducing order for the calls. So you see 11.4 for 130, 9.4 for 135. Similarly in the money 125, 120, 115, they are in the money for calls and they are out of money for the puts. The puts have not yet reached the current price has not yet reached their strike price, so the puts are out of money. So this is just I wanted to show you once again. Going back to this particular session, we'll be talking more about the components of any option. So we'll begin from here. Okay, so in the previous session we have already spoken about the expiry, the strike price that can be in the money or out of the money. You know about in the money and out of the money definitions and what they are. Premium that you pay, the price for each option, it might be showing, say suppose 3.5, but you have to multiply with 100 and you pay $350 to get that contract as a buyer. Now the other components here are open interest, volume, implied volatility, and the Greeks. Why we call the Greeks? Because options are started by the ancient Greek. There are four major Greeks that we have to consider while defining an option. That is delta, gamma, theta, and Vega. Okay, so there are other Greek factors also as well, but these are the four main which I think we should be knowing. Talking about the open interest and the volume, open interest is number of contracts that have been written and they are currently trading in the market. Okay, so and the volume is number of contracts traded on a day. So for suppose I've just given an example over here. Suppose open interest is 20 and the volume for the day can be 80, because what happened over here in this example, you can see Ram sold 20 contracts to Bharat, sold 20 contracts to Lakshman sold 20 contracts to Shatrughan, and the price of that option fell down. So Ram bought it back again from those 20 contracts from Shatrughan. On the same day all these things happened, so the same 20 contracts were traded again and again. So now the volume is 80. A very important point over here, volume is more important for any option. Volume defines the liquidity of that option, whether when you try to buy or sell the option, if you have good volume over there, you can quickly purchase them, and when you want to sell, it will get sold also very quickly. Okay, if the volume is good on that option. Okay, now implied volatility, and I'm just taking one of the Greeks, Vega. Okay, these two can be factored together and we can discuss about them together. Implied volatility is estimate of future volatility of the stock calculated based on option prices. For example, if say suppose Tesla, even if Tesla grew by just $10, you might be seeing that options grew more than what it should be, because there is some news that is cooking within, say suppose some news is cooking for Tesla which has not yet come out and people are buying those calls. Okay, so the since the demand of those calls go higher, so the price of that option gets higher. Okay, the price of that option gets higher than what it should be. Okay, that way implied volatility of Tesla, if you see normally, because there is a lot of movements in Tesla, a lot of volatility in Tesla, so whenever you see there will be high implied volatility for Tesla stocks, there will be low implied volatility stocks for stocks that move very less. For example, AT&T, the stock moves very less in a day, so the implied volatility will be less on that. Vega, the next term the option buyer and the seller should know is Vega. Option prices, the amount by which the option price changes based on the reaction of 1% change in IV. So as the definition, you can understand what is Vega. Not so very important thing, Vega, but IV is important. Okay. When we go in the next presentation, we will talk about these things, how we should factor the IV while entering a trade, and when should we exit the trade. Yeah, I have added one line over here: before any expected news is out, or say suppose before the earnings, the IV is generally high, and after the earnings is out and after the news is out, the IV suddenly falls and the price of the options also fall. Okay, we'll move on to the next slide. Here we have the two Greeks, Delta and Gamma. Delta is the most important part of an option. Okay, so please go through it very carefully and try to understand very precisely. If any questions, please text me in the group. Okay, so rise or fall of a call option, not fall, rise of a call option for per dollar rise in the stock. If the stock price, say suppose Apple, if the stock price of the Apple rises by $1, any particular call option, any strike or any expiry call option, by how much it is going to rise, that is delta. So delta is the best friend of a buyer, of an option buyer. If delta is high, your call is going to rise higher. Okay, so for put options is the same thing. You can, if you understand the delta of a call option, you can understand what is of the put option. So if the stock price rises by $1, the put is going to fall by the value of delta. That is why delta of the puts are negative. Okay, now gamma is another factor. Gamma is rate of change of delta. Delta also keeps changing for every $1 rise in the stock. Okay, so the more you are near the strike price, the delta is high and the gamma is high as well. Okay, if you go away from the strike, if you choose a strike price which is away from the current price, the delta and gamma will be low. Now I have given an example over here. On 19th of January, say suppose on Tuesday when the market opens, the stock price of ABC was 100 and 100, and I have chosen February 1902 calls. Delta is 0.50, gamma is 0.03. If after 1 hour the stock price rises to 101, the same contract, the delta is now 0.53 because the gamma has been added to the delta, and the gamma remains same. Okay, the gamma will rise when the stock rises by $2 or $3 on that, not $2 or $3, 2 or 3%. Then only the gamma will rise. There will be significant change in gamma. Okay. Now talking about theta. Theta is time decay. Because you are losing time on an option. Let me say, suppose if I have, the option is like a bet. Okay, if I am betting on a 102 call that ABC stock is now trading at 100, it will reach 102, and I am saying it will reach 102 in a week. Okay, if it reaches quickly, it is well and good. If it doesn't reach in, say, first 3 days of the week, I have less time. Now the time is less, so theta, the value of theta is more here. The option decays every day by some value, because now your bet is getting weaker. Because of time decay, your bet is getting weaker for that particular call option. Okay, similarly you can understand the same thing with respect to the put option. Theta is always negative because on every day the time is passing and the value of the option is reducing, so theta is always negative. Value of theta rises with time, so theta of far ahead expiry dates, for example, if you choose a June date for any particular stock option, you can see the theta will be say 0.01 or 0.09, like that. If you keep going, if you choose any strike price which is close, say suppose January 29th or February 5th, whichever is the Friday, if you choose those dates, the theta will be more compared to the theta on June 19th options. So here I have given one example here. So for example, on Jan 19th, ABC was trading at 100. The premium we paid was 2.5. The delta for this is 0.50 and theta is 0.13. Next day, on 20th January, the stock rose by $1. Okay, but what happened over here is our option price increased by delta. Okay, so 2.5, it increased by delta 0.5, so now the option value should be 3.00, but that doesn't happen because the option also decayed in price because of theta, and the decay was 0.13, and we have to reduce that price, so 3 minus 0.13, 2.87, so current price of that option will be 2.87, and since we increased one more day, so there will be significant rise in theta also because we are going close to the expiry, so theta also increased by 0.14. This is just examples, don't compare it what I am saying with real examples. The value of theta will be different for different stocks and different options that you see. So this was all I wanted to talk in this particular session. Thank you all for joining. Next session we'll be talking more about the ways to trade an option. So that will be naked options, that will be spreads. There are two main kind of spreads, debit spreads and credit spreads, and then there is another one that is called a calendar spread. So we'll talk about these things in the next session. Thank you all for joining. Wish you a great day.